All right, today we're doing a deep dive into the charts for a masterclass on a pattern that's pretty rare, but let me tell you, it is powerful. We're talking about the diamond bottom. If you've ever wanted to get a heads up on a major market turn before everyone else, this is one pattern you absolutely need to have in your toolkit. Okay, so let's take a look at this. Now, at first glance, I know what you're thinking. It just looks like a bunch of messy, choppy price action. But look closer. You see, after a solid downtrend, the price swings start to get wider. They make higher highs and lower lows. And then they start to tighten back up. That's what creates this very distinct diamond shape. This pattern is telling a story, you see. It's a story about a fierce battle between buyers and sellers, and it's often a huge clue that the sellers are finally getting tired. So here's our game plan. We're going to break this down piece by piece. First, we'll cover what this rare gem actually is. Then, we'll dissect its anatomy so you know exactly how to spot one in the wild. After that, we'll talk about the most important part, the breakout. We'll even look at the hard data to see how well it actually performs. And we'll wrap up with some pro-level trading insights to help you dodge the common traps. So what is this pattern really telling us? Well, think of it as a period of organized indecision right after a long drop in price. On one side, you've got buyers who think they're seeing a bargain, and they start to step in. But on the other, you still have sellers who are trying to push that price even lower. And this tug of war is what creates that unique shape. And it can be the first real signal of a major shift in market mood. So here's the official by-the-book definition. It's what we call a reversal pattern. In plain English, that means it's supposed to stop a downtrend in its tracks and hint that a brand new uptrend is about to kick off. The key thing to remember is how the volatility behaves. First, it expands, you get those higher highs and lower lows, and then it contracts. With lower highs and higher lows, it's a perfect picture of the market fighting it out before it finally makes up its mind. All right, now for the real skill, spotting one of these as it's happening. See, it's not enough to just see something that kind of looks like a diamond. A true tradable diamond bottom has a few specific traits you have to check off your list. This is how you avoid getting faked out by false signals. So let's break down its anatomy. Here's your 3-point checklist. It's simple. Number 1, context is everything. The pattern has to show up after a significant downtrend. No downtrend, no diamond bottom. Got it? Good. Number 2, the shape itself is crucial. The first half looks like the price is fanning out, and the second half looks like a classic triangle squeezing in. And third, and this is a big one, look at the volume. Ideally, you want to see the trading volume slowly dry up as the pattern is forming. And check this out. What's so telling on this chart is the volume down at the bottom. See how the bars are getting smaller and smaller as the pattern takes shape? The trading activity is literally getting quieter as that battle inside the diamond is playing out. That's a classic sign of consolidation. Then, bam, look at that huge spike in volume on the day the price breaks out. That is conviction. That's the market screaming that a decision has finally been made. You know, finding the pattern is one thing, but knowing when to act is the whole ballgame. A pattern is just a pattern until you get a breakout. That's the moment of truth. It's when the stalemate is finally broken and one side, usually the buyers, takes complete control. This is the signal you have to be patient for. So here's a super important point. Even though we call it a bottom, it doesn't always break to the upside. Yeah, most of the time it does, and that signals the bullish reversal we're hunting for. But every now and then, it can actually break downward and continue the old trend. And this is exactly why you never, ever, ever trade inside the pattern. You have to wait for the market to show you its cards with a confirmed breakout. Okay, this is where the rubber meets the road. It's a nice-looking pattern, sure, but what do the numbers say? How does it actually perform when there's real money on the line? Let's dig into the statistics from decades of market data. Let's just start with a headline number. On average, a stock will climb 36% after a confirmed upward breakout from a diamond bottom. Now that is a really solid move, and it just shows you the kind of explosive potential that can be coiled up inside this pattern. And here's the other side of that coin, which is just as important, reliability. In a bull market, the failure rate is just 4%, and a failure here means the price doesn't even rise 5%. That is an incredibly low failure rate. It tells you that when you spot a valid pattern and you get that confirmed breakout, the odds are definitely stacked in your favor. But what about those nail-biting moments right after a breakout? You know, sometimes the price will shoot up and then pull back to retest the breakout point. We call that a throwback. And as this chart shows pretty clearly, throwbacks tend to put a damper on the overall performance. The average gain is a whopping 43% without a throwback, but it drops to 30% with one. It doesn't mean the trade failed, but it does tell you that the most powerful moves, they tend to just take off and never look back. So we know how to spot it, we know what to expect from it. Now let's talk strategy. Because look, trading is just as much about avoiding the losers as it is about picking the winners. So let's look at what can go wrong and how you can spot the absolute best A-plus setups. Because it's going to happen. It's not a matter of if a pattern will fail, but when. No chart pattern works 100% of the time. And believe me, understanding why a trade fails is one of the most important lessons you can ever learn. It's what separates the pros from the amateurs. Take a look at this chart of Cisco Systems. I mean, it looks like a perfect diamond bottom, right? It's got the downtrend, it's got the shape, and it had an upward breakout. But the rally just hit a wall and collapsed almost right away. Why? Well, look to the left. See that huge block of trading from a few months earlier? That created what we call overhead resistance. Think of it like a wall of sellers who bought at those higher prices, and now they're just desperate to sell and get their money back. The diamond just didn't have enough buying power to push through that wall. So what are the big lessons from that Cisco example? First, always look left on the chart. See if there are any roadblocks like overhead resistance waiting for you. Second, if you see a rising volume trend inside the diamond, that can sometimes be a red flag, just like it was here. And third, context is king. This pattern failed during a bear market, and that makes any bullish signal a lot less reliable from the get-go. So, how do we stack the odds in our favor? What do the best of the best performers look like? Well, the data is pretty clear. Tall and wide patterns, those have the most juice. And this one might surprise you, patterns that break out when the stock is near its yearly low tend to have the biggest returns. On the flip side, you want to be really cautious with patterns that are short and wide. They just tend to be the weakest performers. And really, that just sums it all up, doesn't it? A diamond on a chart can look really tempting, but a lot of them will just sink under the weight of the market. They'll fail because of hidden resistance or bad volume or just the wrong market conditions. Your job isn't to trade every single diamond you find. Your job is to find those rare, high-quality gems, the ones that actually have what it takes to float all the way to the top.